Thank you, Charlie. Good afternoon, everybody. Welcome to the webinar. I'm Dave Crook from Pelham James. Charlie and I meet up on a, fairly regular basis, don't we, Charlie, just to sort of discuss business and different industries that we work in. I like to sort of tease Charlie a little bit that the Rutland property market is outperforming the stock market, but he he always has some good comebacks on that. But joking aside, I think everybody has the understanding that a balanced investment is the best way forward, whether it be property, stocks and shares, or anything else. But I think last time we caught up, I mentioned to Charlie that because of the nature of the properties that we sell in Stamford and Rutland, which tend to be at the higher end of the market, we do meet a lot of people that are looking to downsize, whether it's now or sometime in the future. And they're looking to do that for a whole number of reasons. It can be a lifestyle reason, they want to downsize, realise the equity, spend time to go on holiday when they can go on holiday, but equally look to sort of invest elsewhere. And a lot of the people that we meet, they kind of know in their hearts that they want to make the move, but they can be quite resistant to it for a number of reasons. Selling your family house at the end of the day is quite an emotional decision. It can be quite different to just buying stocks and shares, for example. So, you know, a lot of fond family memories there. They might be attached to the village that they live in and the community that they've got around them. And most of the time they're in a financial position where they don't have to sell. So they can take some time to make that decision. And I just wanted to give you two quick stories of where, you know, the people that we've met. There was a lovely couple in their 70s that I'd been talking to for a little while, and they could never quite make that decision to go for it. Again, like I said, they kind of knew that they would. And when I spoke to the wife last time on the phone, you know, she gave me the sad news that, you know, very unfortunately, the husband had been taken ill and it was unlikely that he would be returning to the family home. So very sad, but also, like a lot of people in that generation, the financial affairs have been left to the husband and hadn't, by the sounds of it, done a great deal of planning. So not only was having to deal with a husband and unfortunate illness, but also left with all of this to deal with as well. So in a way, you know, it was a shame they hadn't moved sooner. On the other hand, lovely couple in their early 60s, they were just right, let's get on, do with it, get on and, you know, make that move. They wanted to move on with their lifestyle. They like their local business owner, like lots of us, spent far too much time in the business and felt that they perhaps could have spent more time with their children. So now wanted to make up for it by spending that time with the grandchildren. They didn't have the holidays that they perhaps deserved during that time, and now is the opportunity to do it. So keep the story short, but in essence, they sort of, you know, got on with it and, you know, downsized, still in the local area, and they can't have the holidays they quite want at the moment, but they are ready to do that as and when. So from our point of view, as an agent, that we fully understand it's a very big decision. There are lots of things to consider, not just the financial side, but the financial side is obviously critical, and then also what you do once you've made that decision. So that's how we came about of doing this webinar, didn't we, Charlie? And I think Charlie's obviously got the expertise, and I'll come back to you now, Charlie, and so you can talk through your side. But of course, if anyone's got any questions property related at the end, then, you know, please do fire away.
Fantastic, thank you, David. I'm going to share my screen so that you can look at slides, which will look far better than I do. So David and I were chatting, and of course, you know, your house is for many people, their biggest asset, or certainly one of their biggest assets, and they have all of this value tied up in it. And, as David says, very much the emotional attachment of living in that house. But also they often, particularly once they've retired and children have long flown the nest, that they want to start working out, well, how can I leave the maximum legacy, the best legacy possible for the people I care most about? They've worked hard to build up this legacy. They don't really want it all disappearing. And, the old joke is that, the light at the end of the tunnel is the tax man holding the torch. And we don't really want to find that our wealth is eroded, particularly when we've put so much hard work and effort into protecting that wealth for during our lifetime. We don't really want to see that eroded in big chunks, but as and when we pass away. And of course, we've also constantly worried, people in that situation are often worried about, well, how much is enough money? How much do I need to live off for the rest of my life? And what's the best way to approach this? So there's so many difficult decisions to make around, whether you stay in your home throughout your retirement, or whether, as David says, you do downsize and you kind of maximize that equity. And there are ways that you can do that. So, firstly, you've got this beautiful big house, but you probably rattle around in it. Do you use all of it? And so therefore, can we maximize the value you've got there for the next generation, so that you get to live in a house that's perfectly good for you and fits your needs better, but you actually can leave a legacy to the people you care most about more effectively. And often that legacy, by doing it that way, that legacy can be passed to them during your lifetime, so you can actually benefit from seeing them enjoy that and giving it them at a time when they actually need it more, maybe for school fees and things like that, as opposed to when they're in their retirement and perhaps they don't need it. And you also do want to make sure that you've got enough to be able to enjoy the fruits of your labor, so that you have got, like David says, going off and enjoying the amazing holidays and things like that you've perhaps not done during your working life. So we want to try and create this environment where we're maximizing the legacy that you've built up. That you've got all the money that you need for your lifetime, and you can pass that legacy on at the time that you think is right, not just when you pass away. So that's why I wanted to talk to you this afternoon about leaving a legacy and creating the best of the resources that you have. Because ultimately, this is really important. You've worked really hard to create this wealth, and you don't really want to see your estate divided up with perhaps the chancellor becoming your single largest benefactor. And so planning this stuff is really important, because it's about really thinking about what are my goals? Are my goals to leave a better legacy for my children? What resources do I have at the moment? And how can I create the best opportunities with those, and thinking about the time and the risk and all of that sort of stuff. So that's what I want to talk about this afternoon, and how we can achieve that. But I mean, I know many of the names on this webinar, but some of you might not know who I am. So my name's Charlie Redding. I run a chartered financial planning business primarily based in Rutland called Efficient Portfolio. We're obviously authorized by the FCA. We're truly independent. As I say, we're chartered, which puts us in the top 14% of all financial planning firms in the UK. As well as running the business, I am personally a chartered financial planner myself. And I'm also author of 3 books. So Entrepreneurial Happiness, How to Build an Abundant Business and a Fulfilling Life, which was published last year, right in the middle of lockdown, which was handy. The Dream Retirement, How to Secure Your Money and Retire Happy, and also Smart Money, How to Create Financial Freedom. And as I say, we've got a team based primarily in Rutland, but we do help people all across the country. And, that's led us to be able to help people like, for example, Peter and Sarah. They came to us just before kind of at the sort of start of a phased retirement, but they had real problems around, or real worries around, how they could create the life that they wanted. And we actually, one of the key drivers for them was to being able to relocate down to Cornwall and move different properties around and things like that. So it was actually quite a challenge for them, but we were able to work with them really closely. And now this is Peter and Sarah enjoying St Enedoc Golf Club because they are now living in Cornwall. This was me playing golf with them last summer. For those of you who have played St Enedoc, absolutely stunning course, my favorite course in the UK. But it's those sorts of stories that have led on to the fact that we're now known as one of the top financial planning practices in the UK, not just according to me, but according to the Sunday Telegraph, the Times, and our top industry magazine. But I want to start off by telling you a story that was told to me, or that was about a client of mine. That's a client of mine that's sadly no longer with us. And he said, and this was his words, not mine, but he said, you know, Charlie, life is arse about face. And he said, you know, the reason I say that is because when I was in my 40s and 50s, you know, I'd got young family, and I'd got a wife, and we'd got, you know, I really wanted, there was stuff that we wanted to do, but I didn't have the time or the money to do those, you know, do those trips and those activities with them. And he said, now, you know, I'm much older. My wife has passed away. My children live far afield. But the daft thing is, I've got all the time and the money that I will ever need, and more than I'll ever need, but not the people that I care about with me to spend that with. So it is about trying to create a legacy during your lifetime, not just on your passing. And, you know, I kind of worked out in my 20 plus years in this industry that if you want to leave an amazing legacy, there's really 6 key steps that you've got to master, certainly with regards to your finances anyway. And the first step, like any big challenge that you're going to embark on, you need to prepare. If you don't prepare, they'll end up repairing later on. So we've got to prepare the financial, your finances for the worst to happen, for when the worst happens. Then we need a plan, and we need to be able to see into the future and try and predict what might happen so that we can plan more effectively. Then we need to generate a profit. We need to make sure that the money that we've worked hard to create is still growing and growing faster than inflation. And so because otherwise that asset is being eroded gradually over time. We need, once we've stopped working, we need to generate a pension. Now, that doesn't have to be the product, the pension, but what I mean by that is an income that will last you for the rest of your life. We need to ensure that our plan progresses with us, because of course, things like legislation changes and your situation changes. So we've got to be sure that our planning progresses with us. And then finally, there's the personal element to all of this, creating a legacy. So over the years, we've kind of refined the key steps that help you in each of these different areas. And we put together a number of different approaches. And so with regards to prepare, if you want to prepare your finances in the best way possible, we put all the best ideas into the Don't Wait protection plan, which is going to be the kind of lion's share of what I talk about this afternoon. But we also need to be able to see into that future. And so we help our clients with the Safe Retirement Roadmap, which is where we help them see what their financial future looks like so they can make better decisions today. Then we need to make sure that our assets are getting the best returns possible for a level of risk that they're comfortable with. And so that's where we use the radical investment approach. We want to be able to create an amazing income and dynamic income during retirement so that you can tick off the bucket list as you go. And for that, we created the Dream Income Strategy. And then we help our clients. In fact, what I was doing this morning with a couple of you that were, or 3 of you, I think, that were dialed in this morning was part of the Progressive Review Program, which is how we ensure that financial plan continues to evolve with you, with the ever-changing situation. And then finally, there's the personal side of this, which is where we kind of think more about what the intellectual legacy might look like through the lifelong legacy gift. So as I said, today, I can't go through all the detail of all of these different elements, but I want to drill into some of the key ones that relate to this property debate in, do you downsize or do you not downsize? Because ultimately, how you play your cards with regards to that property will have a significant impact on the legacy that you can leave, primarily because it's actually really quite difficult to plan for inheritance tax when so much value is tied up in your home. It really is quite difficult to do that. You can't give your house away and then live in it while you give it to the children and carry on living in it unless you pay a commercial rent. So that's not very appealing. So I want to dive into how we can really create a legacy, but with this property piece particularly in mind. Now, there's some things that we've got to start off with if we're going to talk about leaving a legacy, and some bits that I just want to, I'll skip over fairly quickly, but it is important that we just cover them. So obviously, it's absolutely vital if you want to leave a legacy that is in line with what you desire. You've got to have a will. Now, most sensible people have a will, because if you don't have a will, then you die intestate. I'm not going to go through this flow chart, you'll be pleased to know, but you can Google it, find out whether it's going to deliver what you actually want. But it's amazing how many people think it will deliver what they want and it actually doesn't. So it's absolutely vital that you have a will as a starting point. But of course, I'm sure you all know that. Second thing that is really important is a lasting power of attorney, because if you don't have a lasting power of attorney, I mean, 2020 was the perfect year to highlight this. If you were incapacitated for any reason, then without a lasting power of attorney, the people that care most about you can't act in your best interests, whether that be from a health and welfare perspective or from a financial perspective. So it's really important that you've got those lasting powers of attorney in place. Because otherwise the mess that gets left behind and going through the court of protection and all of that sort of stuff for them to be able to access your account on your behalf is really difficult. So it's a really important piece of financial planning. But again, I'm sure most of you know this already. So what I want to do now is I want to talk a little bit more about how we can boost the amount of money that your beneficiaries, your loved ones, will inherit. But to be able to do that, I kind of need to start with a foundation knowledge of how inheritance tax works, because if you don't understand that, then we end up, some of this stuff won't make sense. So we all get given a basic rate, what's called a nil rate band, but essentially a basic allowance for inheritance tax. That's currently 325,000 and has been for over 10 years. And so that means that the first 325,000 pounds of your estate will be free of inheritance tax. And above that, you will be taxed at 40%. That means a couple has a combined allowance of 650,000 pounds. Now, one thing to be aware of is the fact that when the Tory coalition government was in place, the Tories promised £1 million allowance, and when the coalition was in, they sort of introduced £1 million allowance. It was called the residential nil rate ban. It's essentially a top up to the nil rate band, so it can take you as a couple up to a total of £1 million allowance. But for larger estates, you won't qualify for it, and you'll be back to your 650. But it is something to be a little bit aware of. If you were going to downsize to a very small house, you might want to just factor this in. But generally speaking, it won't be a problem if for the sort of people that we're talking to at this sort of event, and also for the sort of part of the world that we're speaking about. But it is something to be aware of, that there is that extra allowance, and there are certain things that certain bad strategies in planning that can actually cost your children this residential nil rate ban. So you do need to be a little bit careful of that. There are a whole load of other allowances out there. So there's an annual allowance of £3,000. You can give £3,000 once a year to somebody, and that be free of inheritance tax. You can give small gifts, so as many gifts of £250 to different people as you like, and again, that'll be free of inheritance tax. And you can also make gifts in the event of marriage and things like that. So there's certain allowances for those situations. There's some exemptions as well. So money passed between spouses is exempt. Worth really pointing out, though, that if you're not married, then you could find that even though you're living in a house with your partner, you might end up having to pay inheritance tax to carry on living in that house if you're not married. So just be really careful about that. I've seen that catch a few people out over the years. And And gifts to charity are free of inheritance tax too. One of the things that people aren't often aware of is gifts out of excess income. So giving away extra income is free of inheritance tax, and it leaves your estate immediately. Now, this is again something to bear in mind if you've downsized and you've now got more income than you need. So again, this is another play that you can use to reduce your inheritance tax, and there's no waiting 7 years when it's coming out of income. Now, it does need to be regular, it does need to be out of surplus income, and it can't impact your standard of living. But as long as those are met, then it's a really useful planning tool. And again, one of the things that we quite often talking to clients about where they are downsizing is should they mention making a potentially exempt transfer, otherwise known as a PET. So a PET is where you give capital to your beneficiaries during your lifetime, and as long as you live for 7 years, then that will be free of inheritance tax. Now, it's worth pointing out that most people think that declines over 7 years. It doesn't unless the gift is more than your nil rate band. So unless you're giving away more than 325,000, it will not decline. It will stay level for the full 7 years. But potentially exempt transfers they're free. So you're just giving money away. There's no planning involved. They're really simple. And as long as you live 7 years, they'll be exempt from inheritance tax. So they're quite simple in that sense. However, the downside is, of course, there's no control. Once you've given the money away, you can't ask for it back. There's all sorts of problems that can come from that. It doesn't allow you to access the money again in the future. And so therefore, it's quite difficult to know when the right time to make potentially exempt transfers is. But it's something to be aware of because it is definitely a tool in the armory. And so what I want to then finish off with this particular section is the power of using trusts, because trusts can allow us to protect our assets so much better. And it's worth actually, I'll come back to property and trust later on because there's a better time to mention that. But one thing that is worth really understanding is what's the problem with having just a will? If you've only got a will, then actually it only does half of the job. And the easiest way to explain this is using my own personal situation to explain it. So I'm married to Carol and we have 2 girls, Fionn and Bronwyn. So if we just had a will, then if something happened to me, I would expect to leave everything to Carol. And then when she passed away, we'd want to leave everything to Fionn and Bronwyn. The problem is that often isn't the case. But why would that be? Well, firstly, Carol might remarry after my passing, let's call him Juan, shall we? So if Carol marries Juan and then gets divorced, potentially Juan's walking away with 50% of Fionn and Bronwyn's inheritance. Carol marries Juan and then dies, potentially he's walking away with all of their inheritance. Even if Carol never ends up marrying Juan, when she passes away, everything's in her estate for inheritance tax purposes. Now, of course, the next problem is that the girls are only 14 and 11 at the moment. So if something happens to both of us now, then the money, if we just have a will, would go into a trust for them, but they'd be able to access their entire share the day they turned aged 18, which would probably lead to an amazing Freshers Week, but not a terribly motivated life thereafter. And so therefore, we have a whole load of problems around their life ahead. And then, of course, when they're a bit older, they might marry the son-in-law from hell. He might then divorce them and walk off with half of this money again. And when they want to leave the money to their children, we've got inheritance tax to worry about all over again. So how can a trust framework help? Well, there's a number of ways it can help, but the way it would help in the situation I've just described is that on my death, certain assets would move to the trust immediately. So that would typically be my pensions, my life insurance, my shares in the business, and also a share of my property. And and because, I'll explain why the share of the property in due course. But all of those assets are allowed to be loaned back out to Carol as an interest-free loan. So she can still spend that money in the same way she would have done ordinarily had it just gone directly to her. But there is this loan from the trust. So if she does marry Juan and then divorce or die, we've ring-fenced some of those assets. And we've also managed to get some of those assets out of the estate for inheritance tax purposes. And so what that means is we can actually start to protect that money to make sure it flows down through the bloodline. As and when the children come to inherit it, firstly, if they're not old enough, we're going to have trustees in place to make sure that they get their capital and income at the time that's right for them, not just because they turned aged 18. But even when they're old enough to become trustees of their own trust, they can still take the money out of the trust as a loan like Carol did, because what that means is that if they do marry the son-in-law from hell and then divorce, we've managed to keep that outside of the divorce settlement. And of course, when we want to pass that money down to the grandchildren, or when they want to pass it down to their children, we can skip inheritance tax because on that stage, because the children can return the assets to the trust framework as it was a loan. So it's really effective planning. And it's kind of the starting point for all of the estate planning that we do. And one of the things that's really worth talking about is how we can then use trusts to kind of take that planning to a next stage. Now, with trusts, putting property into trusts is a bit of a messy job, because trusts and property don't tend to interact that well. So a lot of the planning that I'm about to talk about works far better if you've already released some of the capital, which is why David and I got talking about this in the first place. Now, if people have downsized and got capital, it gives them far more opportunity to do inheritance tax planning. And that's because of a piece of legislation one of the reasons of that is called this gift with reservation, which I mentioned briefly earlier. Essentially, you can't have your cake and eat it. You can't give something away and still benefit from it. If you give your house away, put it into trust, then it only works for inheritance tax purposes if you carry on then paying a commercial rent for the rest of your life, which is a fairly unpalatable thing. Certainly not as palatable as these cakes are looking. You can't have your cake and eat it. You can't give something away and still benefit from it. But when you've converted your primary residence into a smaller residence and a load of cash, it actually opens up quite a few interesting planning opportunities. So firstly, what I want to do is I want to go through a number of examples of planning opportunities that you can use capital for. Now, you can't use property for these really, but you can use capital for them. So the first is what we call a protected gifting trust. Now, you can, in theory, put property into a protective gifting trust, but you're going to be paying capital gains tax. You're going to be paying stamp duty again on your own property. So there's not that many situations where it becomes particularly palatable. Plus, the trust will end up probably paying a higher rate of income tax on that property than it will if you own it directly. So, as I say, putting the property into a protective gifting trust is not often that palatable an idea, but putting capital in just means that you can put it in, you can get the 7-year clock ticking. As long as you live for 7 years, it'll be free from inheritance tax, but you've still got control over that money. But it is trust planning in its most basic form. So you can't get access to this money. All you can do is control what happens to that money and when the beneficiaries would get it. A really useful type of trust, though, if grandparents are thinking about paying for school fees, because they can give the money to the children via a trust, and that trust can pay for the school fees, which is a really nice piece of planning. Another type of trust that we can use, again, with capital is what's called a gift and loan trust. Now, we don't use this that much, but it's quite useful if you're already at the inheritance tax threshold, but not a million miles beyond it. Because what that does is it says, well, let's say there's £100,000 in cash. You can put that £100,000 in. That £100,000 you can have back at any time via income or capital, but it doesn't leave your estate for inheritance tax purposes. What does leave your estate is the growth on that money. So gradually over time you spend the £100,000, but the excess, the growth on that money would be outside of your estate for inheritance tax purposes. So it's only useful in a few situations, but it's quite useful occasionally. A better type of planning is actually where, for example, you need an income. So this is what's called a discounted gift trust. And let's say you've downsized your property and you say, well, look, I've got an extra £100,000, but I really could do with an income from that money. So what you do is you put that £100,000 into the discounted gift trust, and depending on your age at the time, some of that money would immediately leave your estate and the other would leave over 7 years. And from that capital, you would typically draw an income back of 5% per annum. So you'd have your £5,000 a year, but roughly, let's say in this situation, £50,000 leaves your estate immediately, £50,000 leaves after 7 years, but you still retain an income. It's a really nice piece of planning where you need the income. And again, something that's just not possible to do it when the money's all tied up in the house. An even more flexible way of doing that is something that's known as a flexible reversionary trust. So very similar to the discounted gift trust that I just described, but instead of having to have an income, the income becomes optional, and it's actually 10%. So each year you put your capital in. Now, the other difference is that this all takes 7 years to leave your estate. But as long as you live 7 years, all of this money will be free of inheritance tax. But each year, if you need the money, you can have up to 10% of it back. But if you don't, you can roll it forward to a future year. And you can actually roll, let's say, 5 years worth of 10% into year 5. So that means in year 5, if you needed it, let's say for a wedding, you could have 50% of the capital back if you needed it. But if you don't need it, it remains in the trust outside of your estate after 7 years. And you can also make loans and appointments out to your beneficiaries during your lifetime. So if you decide that you do want to pay for the wedding, you might want to do it that way. So it's really powerful planning to use trusts in more strategic ways with this capital to get that estate value down. Now, all of the trust types of planning I've just talked about require you to live 7 years for them to be effective. But sometimes 7 years isn't an option. Sometimes that's there's a probability that the individual won't make it through 7 years. So there is another type of planning that we can also use, usually in tandem with the trust planning that we've talked about. And that's what's called business property relief. Again, brilliant way, but you can't do it with property, ironically, despite the name, and I'll explain why. So business property relief is the relief that means if you own a business, you can pass that business down to your next generation free of inheritance tax. So if you're the shareholder in a business that you founded, then you can pass that business on without inheritance tax. But I'm not necessarily suggesting that you go out and start creating new businesses in your retirement just to try and get your wealth down to the next generation. But one of the other types of businesses that qualifies for this is businesses that are listed on the AIM exchange. Now, that means that they are smaller businesses. They are definitely more risky. You've seen Boohoo in the press this week because they're buying Debenhams. Majestic Wine have been bought by Naked. ASOS are obviously doing really well. But ultimately, these are far riskier companies than you'd want a huge amount of your money in. Now, the reason that business property relief is attractive is because once you've held the asset for 2 years and you still own the asset, so you can still sell it, you still draw an income from it. But once you've owned it for 2 years, it's free from inheritance tax. So it's really a brilliant way to incorporate, a brilliant thing to incorporate into your inheritance tax. The downside of investing in AIM-listed companies is you're massively increasing the risk on your portfolio because they are high-risk companies. So there are a number of ways that you can use that capital that you've generated from downsizing to get business property relief, but without taking quite as much risk. And that's because there are vehicles out there that are designed to give you business property relief while manage risk as much as possible. So a couple of examples are some renewable energy investments where the underlying returns are things like the feed-in tariff and the renewable heat incentive, where essentially the returns are government-backed and guaranteed for 25 years. So that's one of the types of investments that you can secure business property relief against. Another type is you can't do it generally against property-based companies, but an example of where you can kind of get around that is through a storage company. Because let's face it, a storage company, if the company goes bust, you've still got the building. The building is really 85–90% of the value of that business. So again, you can invest in businesses like that, knowing that really, even if the company goes bust, the main asset is still there. So there's several ways that you can get business property relief, whilst trying to keep the risk down. You wouldn't want all of your money in this particular area because they are quite niche investments. So that's why it works quite well combined with some of the trust planning. This gives you flexibility around accessing capital and income, but you're restricted on how you invest the money. The trusts, you can invest the money how you want to, but you're restricted in capital or income, as I've explained. So there are some other more extreme, more aggressive ways of planning. And typically where you're holding on to a lot of property, more aggressive planning becomes really the only route for you to look at, because you can't do so much more of the mainstream planning. Now, I would say, with the very odd exception, I would avoid anything more aggressive. The revenue are just so, there's so much anti-avoidance legislation nowadays that anything aggressive is just really not worth talking about. The only exception to that is if you've got your property, you've got a load of properties in an investment company, then there is some planning that's actually not that aggressive. It's still a little bit of a punt, but the opportunity is probably worth the punt. But putting property into trust, as I already talked about, is actually really difficult, which is why downsizing makes it so much easier to do this inheritance tax planning. The same goes for selling buy-to-let properties. If you hold buy-to-let properties, really, you're going to probably end up holding them until the day you die. That's good from a capital gains tax point of view, but it's bad from an inheritance tax point of view, unless you can give them away during your lifetime, but then you will be giving up the rental income. So that's often why we find a lot of clients in retirement selling buy-to-let portfolios and downsizing their property to free up capital to allow them to do more of this planning. Now, there is one last chance saloon for those people that don't want to downsize or don't want to sell buy-to-let properties, and it's essentially insuring the liability. So you can pay for life insurance that will put sufficient money to offset the liability and put that money into trust so that it can just pay the tax. But you've got to be aware, you've got to realize that you're essentially just prepaying the tax. Now, it's probably going to be cheaper than paying the tax, but if you're determined to stay in that property forever, then insuring the liability is probably the best way to go. But you are essentially just prepaying the inheritance tax on behalf of your beneficiaries. So it's not the ideal solution. If you can mitigate the tax, it's usually far better. So hopefully that gives you a few examples as to how you can prepare your finances to get them in the best position possible to leave the best legacy possible. I want to just dive into briefly what we call the Safe Retirement Roadmap, and only a single element of it. Because one of the things that we talk to a lot of people about in retirement is, looking into the future. How much money will you need for your lifetime? And of course, it's the bit that tends to stop people taking action because they're just really not sure. They don't know how much they'll need, so therefore they daren't give any money away, or they don't want to downsize because they don't know what the financial future will look like. So one of the ways that we help our clients see into the future is using a tool called a lifetime cash flow forecast. And this is a tool that we use to help people understand the future impact of the decisions that they make today. And I can also model what that financial future looks like. So I want to just give you an example of what a lifetime cash flow forecast looks like. So this chart is really straightforward. This is the income versus expenditure for every year through to somebody's 100th birthday. Now, you may be thinking 100? I'm not going to live to 100. But actually, the probability is that people on this webinar, a good proportion of the people on this webinar will live to 100. But even if there's only one person on this webinar that lives to 100 and everyone's planned to run out of money at 90, you don't want to be the person that's got too much life at the end of your money. So it's really important that we plan to live, right the way through to 100, even if we don't make it there. Now, this chart shows you a couple of things. You'll see a black line that runs through the very top of it. It's just along the top of most of this. So that's the required expenditure by this person. And by the way, this chart is a genuine client of mine. It runs through right the way through here. Blue blocks are the income that they've got available to them in each of those years. Blue is good. It means there's sufficient income to meet their expenditure. Red is bad. It means there is insufficient income. Their income is too low to meet their expenditure. Second key chart is then what's going on in the background with their investments and their pensions and their savings. Have they spent them all? And so on this chart, orange is pensions, orange is investments, brown is pensions, yellow is cash. And you can see that the reason that that person was running out of income if they reached 100 was because they'd spent all their money. Quite simple. But you know, they've made it most of the way through, right into their 90s. But you will not notice if you look, they've done a good job. You know, they've put a good amount of money in pensions. They've put a good amount of money in investments, and they've got well over £500,000 sat in cash. So these guys were doing well, but they didn't realize they were on track to run out of money if they lived right the way through to 100. So the great thing about lifetime cash flow forecasting is it allows us to model different situations. So firstly, we can model our recommendations. And so for this example, we were able to eliminate that red at the end of their life just by not by taking any more money off them or spending any less, but just by reorganizing their financial planning. The second chart actually tells the better picture, which shows that if they took the advice that we were putting together, not only would they have enough money if they lived to 100, but in today's money, their children would inherit an additional £1.4 million even at age 100. So it's really fantastic. But what it does do is it allows you to model different scenarios. So for example, like we keep talking about in this webinar, what happens if you downsize? You know, what can you do if you downsize? How much money can you spend if you downsize? How much money can you give away if you downsize? All of those things that we can model in lifetime cash flow forecasting, so we can give you a much more accurate view on what your financial future will look like. And of course, something that you can do is something that they refer to at the golf club as ski holidays. No, it doesn't involve snow, or it can do. It stands for Spend Kids Inheritance. So this comes back to exactly what David was talking about at the start, with that couple being able to go off and enjoy the amazing holidays that they wanted to in retirement because they had downsized. And so lifetime cash flow forecasting really helps you to model all of what that looks like, model the bucket list, model more flexible income, and still make sure that you don't run out, even if you make it all the way through to age 100. Now, David's absolutely right. We always rib each other a little bit on which asset class, you know, investments versus property is going to do better. I actually think that in the long run, probably they'll do something similar. So let's park that argument for another day. But one thing is for sure, but whether it's in property or in investments, one thing we've got to make sure is that we're getting your money growing faster than inflation. If your money is going slower than inflation, i.e. putting it in the bank account, then your money is dropping in real terms. This chart just kind of gives you a visual representation of what has happened even if you chase down the best savings account over recent years. The value of inflation, the real value of money, is the blue flat line at the top. Your money in the bank is dropping year on year. And of course, we see this. You know, we know that it's happening. We can buy less with our money today than we could last year. You know, we all know that not only are Kit Kats and Maltesers more expensive, but they're also smaller. You know, I think we get one less Jaffa cake in our packet than we used to. And that's what's happening to our assets. You know, then their asset, if you're not growing and keeping pace with inflation, your assets will be eroded over time. And so absolutely the one thing, so once you've if you look at your finances as a whole, it's absolutely vital that you have a proper spread of investments, because Warren Buffett would tell you that between 80 and 90% of the returns you get will be driven by the split of your investments. But he will also tell you that the most important investment decision you ever make is that split of investments. So having some property is definitely a good thing. We definitely want some property in the portfolio, but you don't want it all in property, because all of your eggs are in one basket. So it's about protecting the assets better from that point of view. And if you do that right, then you can generate really good returns over and above inflation, over and above bank accounts. And And just to prove that point, the blue line here is the average of all split, diverse investment portfolios out there. So, and that includes all the really rubbish ones that you wouldn't go anywhere near. The turquoise line is the line that the investment managers that the majority of our clients are using. So it is possible to do it really, really well. But regardless of what you're doing, if you do downsize, don't leave it in cash, because that if inflation is going to erode your legacy in the same way that tax will. So then we come on to creating an income for the remainder of life. And many of you that are dialing in are already in retirement, or maybe thinking about other people that are in retirement. So we've got to maximize the capital that we've put and the wealth that we've created to generate a flexible and dynamic income. Now, many people in retirement will be spending their pensions and staying in their big house. And the problem that is happening then is that they are spending an asset that's free of inheritance tax, and they're holding on to the one that the tax man's going to take a big chunk out of. So again, one of the benefits for downsizing is that we can stop, say, spending the pension, and we can spend other assets that are taxable. Because with the pension, if you die before 75, it's free of inheritance tax, and the beneficiaries get it free of any income tax, and because you've never paid income tax on that money. Even if you die beyond 75, it's free of inheritance tax, but the recipients pay income tax at their marginal rate when they draw the money out. So a brilliant strategy in retirement is to spend the assets that are taxable and keep the assets that aren't taxable, because that way you've still got flexibility around taking money out, spending it in the future, maybe on care fees or something like that, if that's needed. You've still got that flexibility to access the money when you need it, or if you live longer than you expected, but you've got them in a tax efficient mechanism, like some of the trusts that I talked about earlier. So we really want to preserve these assets as much as possible and spend the taxable ones. Another taxable one that you actually want to spend as opposed to keep is ISAs, because ISAs are liable to inheritance tax. They are a bit of a tax trap. You've been educated all the way through that you should fill up your ISAs and don't miss your allowance. And then, of course, you don't spend them in retirement, and the taxman takes 40% away the day you die. So really spending your ISAs, spending your equity is a great opportunity to minimize the inheritance tax. And when I say about spending that equity, one of the things that we can help you with as a firm is equity release. So if you're determined to stay in that house, and equity release should be the last port of call. It is an expensive solution. It will end up costing your beneficiaries more money. But if you're determined, or you have to stay in the house for whatever reason, then equity release is a way of getting some of that capital out. But it's also, it does make the inheritance tax planning more difficult if that's the reason you're doing it for. So the Progressive Review Program, I've already touched on. Really, this is how we help our clients progress their financial planning over the years, because of course there are legislation changes, and particularly with trust planning, it's important to make sure that it's still structured correctly. But that's a number of tiers of ongoing service that we provide our clients. I'm not going to spend any time this afternoon talking about that. And then there's just the final piece, and this is something that we're working on to kind of do a more comprehensive job with our clients, because creating the best legacy possible isn't just about the money. It is also about some of the other aspects of your life. So it's about helping make sure, like the essentials, like where is the will kept? I found out recently my parents had a safe. For goodness sake, I thought I knew everything about their financial planning, and then I find out they've got a safe that A, I wouldn't have known where it was, and B, how to get into it. So how have you documented all the essentials, like your passwords, for example? In such a digital world, how will your beneficiaries access the things that they need? Then there's your life and the memories, and how have you managed to document that well enough? Your photos, have you written down your stories and all of that sort of stuff, and created other experiences and media for people to learn from your life. And then of course there's your passions. There's things that you can do like mentoring people, helping your community. All of these sorts of things really pull together to create the best legacy that you can. And something that I talk about in the Dream Retirement book, which was published back in 2015, is leaving a legacy, not just a will. And one of the things that I talk about in that is doing the grandparent interviews. So, wouldn't it be amazing if you had a video today of your great-great-grandparents telling you what life was like when they were growing up and what virtues their parents instilled in them and what they did for their living? And wouldn't that be amazing? Well, we've all got the technology to be able to do this today, but so few of us use it in that way. So in the Dream Retirement, I talked about creating the grandparent interviews. And so we've got interviews with my parents and my in-laws, and the questions are all in the Dream Retirement. And in fact, you can see these videos on YouTube and on our website. I'm not suggesting you'd necessarily put yours on YouTube or out in the public domain, but they're good examples for us. But it's just brilliant to be able to pass that legacy on from generation to generation. I mentioned right at the start about ski holidays and enjoying, the arse about face, enjoying the legacy while during your lifetime. So I just want you to imagine just briefly that you're on safari, perhaps you've got the sun setting in the background, maybe over a lake. You see the reflection of the elephants there, and you're with your family drinking a gin and tonic or having a sundowner, maybe nibbling on some biltong or something else. And you've just had the most amazing experience together as a family. You've been able to take your children, your grandchildren on this incredible once in a lifetime holiday. Well, it's those sorts of memories that allow you to create legacies during your lifetime, legacies that you can see and witness. And so keeping all of that money tied up in property, if it's stopping you doing that, you really got to think about how you can create the best legacy possible. So I hope that's been useful for you. I just want to briefly explain a little bit about how we work at Efficient Portfolio. I know some of you on the call are already clients of ours, so you know this bit all too well. But for those of you that aren't, I just want to explain a bit about how we work. So if you want our help after today, a webinar is not the time to be talking about your own personal financial situation. I understand that. So the best thing that we can do is we can organize what we call the financial breakthrough call with one of our financial planners. It's a completely free call. You can spend as long as you want chatting to them but they'll typically take about half an hour. And it allows us to do a couple of things. It allows us to firstly make sure that we can help you. And secondly, we can find the best financial planner in the firm to be able to help you. And if at the end of that call you want a meeting and it's appropriate, we'll book you in for what we call the exploration meeting. And that exploration meeting, because you've been through this webinar, because you've been referred in by David, will be also free of charge. It's a 90-minute meeting with one of the chartered financial planners at Efficient Portfolio. And it'll allow us to tell you a bit about how we work, help you understand what's good and not so good about your current situation, and then most importantly, help you think about what's important to you in the future, because only really once we've all got a clear understanding of that, can we help you build a plan for it. We'll then build your own bespoke financial plan, which we call the Efficient Financial Plan. That'll be the thing that contains all of the inheritance tax planning suggestions, all of the lifetime cash flow forecast, all the trust framework ideas. We charge a flat fee to do that work, and we'll be able to tell you at the end of that first meeting what that fee is, just as soon as we know what work's involved. But that fee is covered by 100% money back guarantee. So even if you were to get the plan and think, what on earth has David referred me to these idiots for? Then no questions asked, you can have your money back. And once you've had a chance to read the plan, you'll get back together with the financial planner. He can answer any questions that you've got, explain certain concepts, and assuming you like them, we'll be able to implement them for you. And then that's where the progressive review program kicks in, so that we can make sure your financial planning evolves with you rather than stagnating as otherwise would be the case. There's a whole team of us in terms of the financial planners at Efficient Portfolio. So it is important that we find the best one for your specific situation, which we'll do on the financial breakthrough call. We all have our own different areas of expertise. Most of us are based in the Rutland area, but Henry tends to cover our London and Oxford office. Richard's a little bit more nomadic, but Tom, Tim, and I are predominantly based out of our Rutland office, but I'm in London a bit as well, or used to be anyway. I'm now just on Zoom. We've got a team of client relationship managers. So one of the things we pride ourselves in is giving that consistent and ongoing service. And the client relationship managers are therefore always on hand to be able to pick up the phone, answer an email, and just make sure that your question is answered as quickly as possible. It is very much a team approach with regards to the financial planning, as I've just described, but also with the investment approach. You know, it doesn't matter which financial planning you see, you'll end up with the same investment approach from a company-wide perspective. And again, the progressive review program is very much a team approach. So, you know, Tom and I were both doing the webinar, the client review workshop webinar this morning, but we'll have elements that are done by client relationship managers. It's very much a team approach. So I just want to show you one very quick video of a client that came to us with a predominant concern of inheritance tax planning, so that you can see what he said.
Before I came to Efficient Portfolio, my affairs and investments were being handled by another organisation. I was telephoned by my accountants and said, was I happy with the service, and I wasn't. And they said they were looking for an alternative, which turned out to be Efficient Portfolio, and eventually I met Charlie and have been very happy ever since. Well, first of all, Charlie was very personable, much younger than I had expected, to be honest, having dealt with a lot of crusty individuals in the past. He seemed to be very knowledgeable, keen to understand what our requirements were, and I can honestly say I think he's done a very good job for us. Approachability, being able to pick the phone up and talk to anybody, to email, to get a response to emails instead of being left in the dark. Communication is the key to any successful business, and I think Efficient Portfolio provide that. If I was asked by anybody about the sort of services that a financial planner can offer, particularly to those retiring, wanting to preserve their wealth and at the same time have a decent standard of living, seek out the good ones. Efficient Portfolios was unknown to me until 3 years ago, but has proven to be a very worthwhile exercise. Don't be put off by what the costs might be. As long as they are showing you a profit, then it's worth taking the advice and leaving it to the experts like Efficient Portfolio.
Thank you, Roger. As you can tell, he's a bit of a character. So basically, if anybody on this call, somebody we don't know that would like to have a conversation with one of the financial planners at Efficient Portfolio, the best thing to do is to email me, as you've been to this webinar. So email me at charlie@efficientportfolio.co.uk, and I'll be more than happy to organise that for you. It just is with doing a webinar, it's the best way to find out a little bit more about you. I say it says 15 minutes there. If it's half an hour or whatever, it's just a conversation with one of the financial planners to get to the heart of your concerns and to check that we can help. And finally, we say at Efficient Portfolio, it's all about helping people create a better future through inspirational financial planning. I hope this evening I've been able to give you some ideas as to how you can create a better future for you and your loved ones through some inspirational financial planning. Thank you very much for dialing in. If you've got any questions for me or for David, or indeed for Andrea, who covers kind of the lending side of our business, then now would be a great time to ask them. But thank you very much for dialing in, and it's been a pleasure to speak to you all. So let me stop the share. We'll all come back in the room. Does anybody have any questions? I haven't seen anything pop into the chat, no, or have I stunned you all into silence?
Charlie, can I jump in?
Oh, yes, please do.
Yeah, I guess one of the questions I might have is that when should people start talking to you if they have sort of made that decision, or or considering their downsizing, because obviously from going through your presentation, it clearly demonstrates that it's a lot more complex than just getting the equity out and putting it in your bank. That's just not going to work. So what sort of time frame would we be looking at?
I would say it's a great question, actually, because all too often people go through the exercise of downsizing. They've then got a big lump of money sat in their bank account, and then they come to us and they go, right, Charlie, what do we do with it? Well, I really could have done with a bit of notice, because you now want to take action. You want to do this stuff. But as you've seen, building a multi-layered approach to the inheritance tax planning strategy with different types of trust frameworks in there, and or a trust framework, different types of trusts within that framework. Also, perhaps building some business property relief in there. All of that takes a huge amount of time, not just to build the strategy, but to make sure that you as the client are really comfortable with it. So I would say at least 3 months before you get the money, because 3 months is typically how long it takes us to build this type of strategy. But really, you want to have time so that you've got time to think about it and make sure that you make the right decisions. So as soon as possible is the honest answer, even if you've got this plan that then sits there waiting for 6 months, because that's when you actually end up selling your house. Much better to have the plan sitting there waiting than start to try and build the plan once the cash arrives. So yeah, as soon as possible is what I would say, but ideally no more than 3 months beforehand. It's never too late, clearly, but it's just better, because you know the money will be sat there in the bank account burning a hole in your pocket, and being eroded by inflation. So the sooner you've got your head around it. One other thing that's worth bearing in mind as well, actually, which kind of your question has made me think of, quite often the trust planning piece is too big a step for people to go or to do all in one go. So quite often what we've also done for clients is we get them invested. That way the money's not being eroded by inflation, but that way we can then take our time with the conversation around inheritance tax planning. And then at the right time for them, once they're completely comfortable with that plan, and once they've kind of got their head around the money, then we can move it into the inheritance tax planning vehicles. It doesn't cost them any more to do that in 2 steps. We don't ever charge the same money twice. So it's there's no extra cost involved, but it just allows them to take their time if they need to.
So there's a lot you can do even before you get to that stage of having the money.
Absolutely. And I think, the other thing is that using the lifetime cash flow forecast and having that beforehand helps you make those decisions like, right, okay, well, once I've downsized, I can afford to put this amount into trust, or I can afford to give this much to the kids now, or whatever it is. So it's that doing that lifetime cash flow forecast, we find it just allows people to make decisions. People end up like stuck, like rabbits in the headlights going, oh, I don't know what decision to make, therefore I'll just make no decision. Whereas the lifetime cash flow forecast just maps it all out, gives you clarity, and it allows you to make decisions today because you know the impact of those decisions in the future.
Thanks, Charlie.
Anybody got any other questions? I see there is something coming up in the chat. Thank you very much. Food for thought. You're welcome, Ian. Thank you for dialing in. Anybody else got any questions? If you want to pick that up with me afterwards, please just, as I said, email me at charlie@efficientportfolio.co.uk, or if you need any help from Andrea with regards to lending, andrea@efficientportfolio.co.uk. And if you need help selling your house, the best people that can be doing that for you is obviously Pelham James. And David, what's the best way for them to contact you?
Just either on the telephone number, or my email address is very simply david@pelhamjames.co.uk. But all the information's on our website. Just Google Pelham James. But yeah, it'd be delighted to have an initial chat with anyone on the phone. And of course, if you'd like me to come out to the house to have a more in-depth chat, then obviously be delighted to do so.
Fantastic. Well, on that note, thank you very much for everyone for dialing in. Unless there's any questions coming in, nobody's got their hands raised, nobody's written any questions down. So I hope that's been useful. Have a lovely evening, and thank you very much again.